following presentation is brought to you as a courtesy of Forex Academy. This is part of our service, Courses on Demand. If you find this interesting and wish to be updated on new releases, please subscribe to our YouTube channel or join our community at forex.academy and receive all of our services for free. Your like is also highly appreciated. Enjoy!
Let's look at volume with technical support. Technical traders observe the volume around key levels of support and resistance. These levels may be long-term price interest points over a long time period, or technical support levels such as an indicator like a Fibonacci retracement. These levels can often cause a congestion of trading, and what this is known as, guys, is price consolidation. An increase in volume is often seen as the early sign of a trend as prices push away or move away strongly from consolidation and evidently they find price direction. Let's look at this in some detail and just discuss it very briefly. Just above here, we have a very well confirmed, technically very well confirmed level of technical support and resistance, and we see that price consolidating just above the level. So above, what we see here is the market trading down on various occasions. I'll just use my pen to highlight. Obviously, we can see with the black S's for support, the market actually trades down past the level and actually continues to trade up again. And that is indicative of each one of these time periods here. We see the market trade down, trade up, and close above the level. Here it's very volatile within this price action again, but not convincing to either way. And again, 1, 2, 3 with these candlesticks, it's rejecting the downside. This is a very conformative level of price resistance, where traders do try and force the price below this level, but it does not want to close below the level, and effectively above our price level. Technical support is very strong indeed. Now, what does that mean when prices actually trade below the level and close below the level? Well, it's very significant. So the candlestick itself is very significant because in this example, we have a bearish, very strong sign that the market is continuing to trade down. And what we see is, if I just use my Epic pen here again, I'll use a different color to depict that. What we actually see is the market closing below the level here and continuing to trade. Why is this significant in terms of using volume as a technical support? Well, evidently we see volume rising above these levels here, volume rising above nominal levels, and again here we get a close where volume is actually very high indeed. I do believe it's our highest level of volume, trading volume for the given range. So very technically significant indeed. And as prices close and continue to trade below the level, volume is still quite high. So that gives us a sign as we go back to our fundamental discussion. The level of interest or participation, the level of agreement between traders seems to conform. That evidently we've closed below the level and we're not retracing. We're happy below the level and prices may shift. So eventually the trading congestion leads to a breakout and creates new price direction. This is also supported by an increase in volume to the downside, as we can see in the chart. Let's have a look at the cocoa market here. So we have our two levels of long-term price support here, two technical support levels, both a ceiling above here at 2171 and a floor technical support at 1798. And as you can see, there is a long-term level of price congestion between actually trading these candlesticks. We can see the price does break down, but we see a long zigzag price congestion, no real structure until we get to these levels here. Can we decide, well, this is the second time we've actually been towards these price levels here, 2171. How is prices going to react? How is volume going to react? And what story does that tell us in terms of price action and future trading momentum? Well, let's have a look in a little detail here. We see at point A, we see the market break up, and what significance is that in terms of volume? Well, we have low volume. It actually causes a false breakout and trades to the downside. And there, just below point A, we can see volume it actually decreases as the market breaks up to the upside. Then we see the market continue to trade with an increased low level of volume until we actually move forward as the market trades. We see very, very low average volume with a break up to the upside, evidently as the market comes back to our long-term price point. Just here below, we see B breaking up to new prices, and that is supported again actually by an increase in volume, actually resulting to the breakout to the upside. We can see a very low level of volume, and then as we shift towards our long-term price resistance level, volume pushes us through that level and actually closes above it. Now we're away to the upside. So very, very significant in this chart, using volume to indicate a breakthrough through technical support.